All right, y'all. So we got another video right here. This one jam packed. So, try to keep your focus, pay attention, keep attention. So in this video, we're gonna talk about whether you should consider paying off your home mortgage versus investing those payments that you would have made towards your mortgage. So right here we're going to look at, let's say you have a mortgage for $200,000, and so let's say this will probably be a condo. This would be more for a condo because you're not finding no house for $200,000. So we're gonna say this is a condo. Let's say you get a condo for $200,000 and the interest rate is 3%. Payback period is 30 years. That will give you a monthly payment of $843.21. Keep in mind, this is not including property taxes or insurance, nothing like that. This is just the mortgage, the actual loan, and the interest. That's it. That's what this payment is for. So, if you paid the minimum monthly payment for the 30-year period, you will end up had paying $103,554 in interest. And the total cost for both the mortgage, the loan, and the interest would be $303,554. So that would have been the everything that you paid if you had only paid the minimum amount for 30 years. You would have paid $303,000 in total. So down here we're going to compare paying off the mortgage early versus investing in the stock market. So we're going to compare three scenarios. One is if you have extra money and you can afford to pay $100 extra for your mortgage payment. If you have $200 extra you can afford to pay, or $300 extra you can afford to pay. So right now we're going to look at paying off the mortgage early, right? So if you said, hey, I want to pay off my mortgage early, I don't want to wait 30 years, right? So we're gonna go into that scenario and see what happens. So if you paid $100 every month for every month throughout the years, it will take you 25 years to pay off the mortgage. So you say 5 years, right? That will bring your monthly pay. You would have been paying $943. So it would have been this $843, the minimum amount for the loan, plus the extra $100, which would bring you to $943. The total amount you would have paid for the mortgage and the interest would have been $285. So you would have saved $18,256 in interest by paying the $100 every month consistently, right? You would have saved 5 years and you would have saved $18,000 in interest. Now, we're going to compare this once we get down here. But this is basically saying the cash after the mortgage is fully paid, you don't get no cash. Once you paid it, that's it. Like that's it. I just keep that in mind. You don't get any cash. That's just it. So now we have scenario 2. Scenario 2 is if you paid $200 extra every month. If you can afford that, and you say, hey, I want to do the $200 extra every month, you would bring your payoff time down to 21 years. So you would say 9 years. 9 years. The monthly pay would be $1,043. The total amount paid would have been $272,000. So you would have saved $30,910. And yeah, again, you don't get anything. That's it. Just keep this in mind. Scenario three, $300 you're paying extra every month. That will bring your payoff time to 19 years. So 19 years, you save 11 years, and the monthly pay would be $11.43. The total amount you would have paid is $263, and the amount of interest you would have saved is $40,230. Right? Not bad. So now let's go down here and say, hey, rather than I want to see what happens if I take this extra money and invest it in the stock market, as opposed to paying off the loan every month. Instead of putting that money towards the loan, the mortgage, I want to put that in the stock market and see what happens. I want to see what happens if I go that route. So the average stock market return is around 10%. So if you get an ETF or something like that, a well diversified portfolio, you can get around like 10%, and this is being conservative too. By the way, this is being conservative. You can make a lot more money than this really, but we're gonna say you want to go the conservative route. You don't really know, too much, and you don't have that much knowledge on investing like that. You want to play it safe, so nothing wrong with that. Nothing wrong with that, right? So we're gonna see what happens if you get 10% annually, right? Yeah, so we're comparing $100 going towards the loan versus $100 going in the stock market. So with this, after 25 years, and we're keeping the same amount of time, because we want to compare the same amount of contributions. So 100 a month, every month for 25 years, going towards the mortgage, versus $100 every month going in the stock market for 25 years. So that's why the years are going to be the same. So if you take $100 every month for 25 years in the stock market, this is what your future value would be: $118,000. If you don't take no money out, you leave it in there, let it sit, and it's growing annually at 10%. This is what your future value would be: $18,000 after 25 years. Now the contribution that you put, right? We have to take this out because this is not your profit. This is the money that you put in there, right? So all of those $100 payments every month, after 25 years, it would have amounted to $30,000. Right? So this $118,000, the total amount of money in the stock market, minus what you put in, the $30,000, will give you $88,016. Right? Now we have to pay taxes on this profit. So we're going to have to pay capital gains tax. It's different brackets really, but 15% is probably what most people. I just chose 15%. That's probably what most people going to fall into. Let's just say that, right? If you're in a different state, I'm in Florida, so we don't have state taxes, so it might be a little different for wherever you are. But I'm in Florida. We don't have any state tax, so we just pay the federal level. So after taxes, we'll have this. We would have this much on our gains, right? So now our total future value after the taxes would be $104,814, which is the actual gains after the tax on the profit right here, the net return after the capital gains, plus the contribution. This is like the total amount of cash that we'll have. The $30,000 plus the $74,000 on the actual like gains, the actual return, right? So we'll have $104,000. Now keep in mind, like this, after you pay the mortgage off, you don't have any money left. You just paid it off. You paid it off, no money left. That's it. Like there's no money. You paid it off. No more liability. If you go this route, you'll have this much left. You paid the same amount towards the loan. Uh, in comparison to the stock market, you paid the same amount for both. But this route, this is how much you have on hand, right? After the 25 years, we're just looking at scenario 1, pretty much. Now, keep in mind though, if you go the stock market route, you're gonna have a remaining mortgage balance. You're gonna have a remaining mortgage balance. This paying off the mortgage, you're not gonna have anything left, no mortgage left, because you were putting the extra money towards the loan. If you went the stock market route, you weren't putting the extra money towards the loan. You were putting it towards the stock market. I hope you guys understand that. So you will have this amount left to pay. So you have like 5 years left to pay for the loan, right? And then you'll have this much left to pay for the loan. So let's say, we're gonna say, hey, you got this $104,000 after the 25 years, and you say, hey, I just want to go ahead and just pay off my mortgage. Boom. You're just gonna pay the rest off, right? If you pay that off, you're gonna have $57,887 left. Now, this is $57,887 left, as opposed to nothing left. You're not gonna have nothing left, if you were to put the money towards the mortgage. Yeah, you paid it off, but you don't have any cash left. But if you would have invested 10% annually, you will have this amount left. And keep in mind, this is being conservative too. This is being conservative. So you will have this amount left. So you pay off your mortgage. It's the same thing. You pay it off in both scenarios, right? Both cases. But you'll have cash. You'll actually leave with some cash. And so it's the same thing for if you invested $200 in the stock market versus the mortgage. You walk away with $58,000 in cash after you paying your mortgage. So there's no more mortgage. There ain't no more mortgage left. And then the $300 investment in the stock market, you will walk away with $72,000 after the taxes and everything. You'll have $72,000 left. So it's all about working the numbers. Before you do anything, you always want to work the numbers. Numbers can change, or numbers can it can change in different scenarios. So don't think like, oh, if I put more in the stock market, I'll gain more. It's weird how the numbers work. So everything you do, you wanna like do the numbers first. Don't just assume. Don't assume with numbers. Do the numbers first. But in this scenario, we can clearly see that putting the money in the stock market, those extra payments in the stock market versus the mortgage payment, we will come out better. So I wanted to make this video because I hear a lot of people speak about paying off your mortgage early, but just consider investing those extra payments before paying off your mortgage, before just jumping the gun, because you're still paying off in the same amount of time. You see what I mean? I compared the same amount of time, but the same amount of time. The only thing is you'll have a mortgage remaining, if you put your money in the stock market, but you can just pay the mortgage off and walk away with cash left. So that's pretty much it. That's pretty much it. If you guys have any questions, leave comments or whatnot, and I'll probably put the link to like the calculator that I use, the loan amortization calculator and all of that, so you guys can kind of work through the numbers yourself, and you kind of double check my work too. You make sure I'm not putting anything wrong, making any mistakes. So thank you guys for watching, and I'll see you next video.